Mabuhay, and welcome back to Financially Smart Pinoy. I'm Lex.
And I'm Vera.
And we are so glad you could join us for another deep dive.
Today we're tackling a question that's super important for any Filipino who wants to be financially independent.
Which is better for investing in Philippine stocks?
Mutual funds or UITFs.
Now, before we get started, make sure to hit that follow button and share this episode with anyone you think might find it useful.
We really believe that teaching Filipinos about personal finance is one of the best ways to help everyone reach their financial dreams.
That's right.
So for this deep dive,
We're going to be looking at an article that one of you awesome listeners sent in.
it breaks down the decision into two parts.
And we're going to do the same thing.
First, we're going to figure out how these funds have performed in the past.
Then in part 2, we'll switch gears.
And figure out how to use that knowledge to make good financial decisions for you.
That's right. And we'll make sure that you can use what you learned today.
To take action.
And we'll even talk about ways to see how well your investments are doing over time.
So let's jump right in.
The article uses the Philippine Stock Exchange Index Total Return Index as a benchmark
You might know it as the PSEi Treynor.
to compare how these different funds have performed.
Now you might be wondering,
Why are we using the TII?
and not just the regular PSEi.
The article explains that the PSEi TRI includes dividends.
Which makes it a better comparison because both mutual funds and UITFs also reinvest dividends.
So we're comparing apples to apples.
Right.
We want to make sure that we're comparing similar things.
And while we're talking about comparisons,
The article uses a few ways to measure risk.
like the Sharpe ratio
The Treynor ratio.
and Jensen's alpha,
I know these terms sound kind of complicated.
but they're actually pretty simple.
Once you understand what they measure,
Just think of them like tools to figure out
how much money you're making.
for the amount of risk you're taking.
Okay, give us an example.
So let's say you have two funds that both made a 10% return last year,
Okay, so on the surface, they look the same, right?
right?
They both made 10%,
But what if one of them changed in value a lot throughout the year?
and the other one was much more stable.
That's where the Sharpe ratio comes in,
A higher Sharpe ratio means you're making more money.
for the amount of risk you're taking.
So basically, in that example, the more stable fund would probably have a higher Sharpe ratio.
Exactly.
You're making the same amount of money.
But with less risk.
What about the Treynor ratio?
That's similar to the Sharpe ratio,
But it looks at a different type of risk.
called systematic risk.
What is systematic risk?
It's the risk that comes with the market as a whole.
Things like,
Like if the economy goes down,
you can't avoid that kind of risk.
even if you spread your money across different investments.
Gotcha.
A higher Treynor ratio means
That you're getting a good return.
you're taking on that unavoidable market risk.
Makes sense.
Okay, what about Jensen's alpha?
What's that one tell us?
Jensen's alpha tells us how much better or worse a fund did than we would expect.
Based on its risk level.
If it has a positive alpha, it means the fund did better than we thought it would.
And if it has a negative alpha, it did worse.
Yeah, it's basically a way to see
If the person managing the fund,
it's actually adding value.
or just matching the market.
Exactly.
So these risk measures can really help us understand if the returns we're seeing.
Are really worth the risk.
For sure.
Now let's dive into how these funds have actually performed.
Starting with a long-term view.
A 15-year period from 2008 to 2022.
That's a pretty long time.
It covers the longest bull run.
In the Philippine stock market.
That's right.
So the market did really well during that time.
From 2009 to 2013, the PSEi grew a lot.
So over those 15 years, how well did the PSEi TORI do?
The PSEi TRI had an average yearly return of 6.65%.
That's not bad.
But here's the interesting part.
What's that?
Only one fund beat that benchmark consistently for the whole 15 years.
Wow, only one.
And it was a UITF.
So only one out of all of them.
All the mutual funds and UITFs.
I'm kind of surprised.
I know, me too.
I thought more funds would have been able to at least match the market,
You would think so, right?
especially during such a strong bull market,
That just goes to show.
that it's hard to beat the market over long periods.
Consistently.
Consistently, right?
And when we look at those risk-adjusted measures,
Do you mean like the Sharpe and Treynor ratios?
yeah, for that same 15-year period,
UITFs were looking really good.
especially when you look at the Sharpe and Treynor ratios,
Only a few mutual funds even made it into the top 5.
for those rankings.
Interesting.
So it seems like UITFs were giving better returns for the risk.
Over that 15-year period.
Right.
Okay, so let's move on a little.
What happened between 2013 and 2022?
Okay, so a 10-year period.
Yeah. Things calmed down a bit in the market.
They always do after a big bull market.
The PSEi TRI had a smaller average yearly return during that time.
How much smaller?
It was only 3.14%.
Oh, wow. So less than half of what it was for the previous 15 years.
Yeah.
But still positive, though.
It is, but here's the thing.
What's that?
Not a single mutual fund or UITF was able to do better than the benchmark over those 10 years.
Not a single one.
Nope.
Really?
Really?
So does that mean...
That we should rethink investing in the Philippine stock market.
That's a really good question.
It's important to remember that what happened in the past...
It doesn't guarantee what's going to happen in the future.
Right, we can learn from the past.
But it doesn't tell us exactly what's going to happen next.
And lots of things can affect how well the market does.
Like what kinds of things?
Oh, there are so many.
Like what?
Like global pandemics.
Oh yeah, nobody saw that one coming.
Exactly.
So just because the market didn't do so well for a decade?
Doesn't mean Philippine stocks are bad investments.
Okay, that makes me feel better.
But it does mean we need to be careful when choosing funds.
And not expect to get rich quick.
Exactly.
So even though no fund beat the market for those 10 years?
What about those risk-adjusted measures?
Did any type of fund do well when you look at those?
Yes, actually.
Which one?
A mutual fund actually had the highest Sharpe and Treynor ratio.
For that 10-year period?
Yep.
So even though no fund could beat the market overall, a mutual fund still had the best return when you factor in the risk.
That's right.
That's pretty impressive.
Okay, now let's look at the most recent 5 years.
From 2018 to 2022.
This is when COVID hit.
So the market probably didn't do so well during that time.
You're right.
So tell me what happened.
Well, as you might expect, the PSEi, TRI, took a hit.
Did it go down?
It had a negative average yearly return.
How negative?
Negative 3.44%.
From 2018 to 2022.
Yep.
Wow, that's a big difference from how well it did over the previous 15 years.
It is.
So even with the pandemic, were any funds able to stay positive?
There were actually 7 UITFs actually did better than the benchmark during that time.
During COVID?
Yeah, and one even made a positive return.
That's amazing.
I know, right?
To make a positive return during a global pandemic.
That's impressive.
What about those risk measures for that same period?
Any standouts?
Spill the tea.
It's kind of a mixed bag.
How so?
Well, when we look at the Treynor ratio, UITFs did really well again.
So they were in the top 5.
They took all of the top 5 spots.
Wow.
But for the Sharpe ratio...
Mutual funds took the lead.
Yeah, they got 3 of the top 5 spots.
So it seems like there's no clear winner when it comes to mutual funds versus UITFs.
That's right.
Each type of fund has done well at different times.
Exactly.
It really just depends on the time period and how we measure risk.
And that brings us to a really important point.
What's that?
Past performance.
Is not the only thing we should think about.
Right. It's important.
It's not the whole story.
Exactly.
And this is where the conversation gets personal.
In part 2 of this deep dive,
We'll switch from looking at past performance.
to focusing on your financial goals and how much risk you're comfortable with,
We'll talk about how to use what we've learned today.
to make a plan that works for you,
But first, we want to make sure we all understand a few basic things.
so we can all be on the same page. Welcome back to Financially Smart Pinoy. So before we start figuring out how to pick the right investments for you, we should probably make sure we're all on the same page about some basic stuff.
Yeah, like what exactly does pooled fund mean?
Right. Not everyone might know that term.
Basically, it's where a bunch of people
You and me.
pool our money
To
together.
buy a bunch of different investments.
It's kind of like,
Teamwork for investing.
yeah, exactly.
It lets us buy more kinds of investments than we could if we were just investing on our own.
And that leads us to another term,
That we've mentioned a few times.
tracking error.
This is super important to understand.
Especially when you're comparing mutual funds and UITFs over long periods of time.
It can get a little technical,
So can you explain it in a way that anyone can understand?
even if they're brand new to investing.
Sure.
So imagine you're trying to follow a recipe,
Okay. Love to cook.
and the recipe tells you exactly what ingredients to use.
And how much of each one?
But you decide to get a little creative.
And make some substitutions.
Maybe you add a bit more of this.
Or a little less of that.
The final dish might still be good.
But it won't be exactly like the recipe.
Right.
So in this case, the recipe is like the benchmark.
Like the PSEi.
And the changes you make are like the decisions the fund manager makes.
To pick slightly different investments than the benchmark.
So tracking error measures how different a fund's returns are.
From the benchmark it's trying to track.
So if the tracking error is
It
big,
means the fund manager is being more active.
they're making more changes to the recipe.
Exactly.
So a big tracking error isn't always a bad thing.
It depends.
Some people want a fund that basically does the same thing as the benchmark.
And some people are okay with the fund manager trying to do better than the benchmark.
Even if it means taking on more risk,
Exactly. And it all comes back to those risk measures.
like the Sharpe ratio and the Treynor ratio.
They help us figure out if those changes the fund manager is making are actually working.
Are they getting us a better return for the risk we're taking?
That's it.
Okay. I think we're all on the same page now.
So let's talk about you, the listener,
And your own personal finance journey.
because all these numbers and data only matter.
If they actually help you reach your goals.
It's not about blindly following the market.
It's about investing in a way.
That helps you live the life you want.
So let's start with the basics. What are your financial goals?
Are you saving for a down payment on a house?
Maybe you want to pay for your kids' education
Or maybe you dream of retiring early.
and traveling the world.
It could be any of those things.
Or something completely different.
The important thing is to figure out what you want.
And write it down.
It'll help you stay focused.
Especially when the market gets crazy.
And once you know your goals,
You can start thinking about how much money you need to make from your investments.
to reach those goals,
This is where we need to do a little math. How much time do you have?
what are you starting with?
How much can you save each month?
All of these things will affect how much your investments need to grow.
And it's important to be realistic.
If you're expecting to double your money overnight,
You're probably going to be disappointed.
and you might end up taking too much risk.
Speaking of risk,
How much risk are you comfortable with?
can you handle big changes in the market?
Or do you want something more stable?
Even if it means potentially making less money.
There's no right or wrong answer here.
It all depends on you.
What are you comfortable with?
Remember, investing is a long game.
Not a get-rich-quick scheme,
You need a plan that you can stick with.
even when things get tough.
Now, the article you sent in mentioned a really helpful resource,
It's called My PF App 2023.
and it can help you compare different funds,
It was made by Personal Finance Advisors Philippines.
which is a really great organization that helps Filipinos learn about personal finance,
This app has tons of information about different investments.
including mutual funds and UITFs.
You can look at their past returns.
Those important risk measures we talked about,
You can see how much they charge in fees.
and so much more.
It's all in one place.
It's like having your own personal financial advisor right on your phone.
Exactly.
And if you're feeling overwhelmed,
Or you want more personalized advice.
the article suggests talking to a financial advisor
They can help you make a plan.
that fits your specific goals, your risk tolerance, and your financial situation.
So let's recap.
You've figured out your goals
You've thought about how much money you want to make.
and how much risk you're comfortable with.
You've even started researching funds.
Using the MyPF app,
Or maybe you've talked to a financial advisor.
you're ready to start investing.
But what's next?
That's where monitoring your progress comes in.
Investing isn't something you do once and then forget about.
The market is always changing.
And so is your life.
You need to keep an eye on your investments.
And make changes as needed.
So how often should you review your investments?
And what should you be looking for?
Some experts say you should check at least once a year.
But it really depends on how comfortable you are.
And how hands-on you want to be.
The key is to pay attention.
And make sure your investments are still helping you reach your goals.
We've covered a lot today.
From analyzing past performance to understanding those key concepts,
And most importantly.
making sure your investments match your financial goals and risk tolerance.
And remember,
There's no single answer.
when it comes to choosing between mutual funds and UITFs,
The right choice for you,
depends on you.
your goals and your dreams. Before we wrap up, we have a question for you.
Something to think about.
But first, a word from our sponsors. Welcome back to Financially Smart Pinoy. We've been talking all about mutual funds and UITFs,
Breaking down how they've done in the past.
and most importantly, figuring out how to pick investments.
That will actually help you reach your financial goals.
Now it's time for that final thought-provoking question,
That we promised.
the one that's going to stick with you.
Long after this episode is over.
Okay, I'm ready. Hit me with it.
What's one thing you can do today
No matter how small.
to start looking into mutual funds and UITFs?
That could help you reach your financial goals.
I love that question.
Any call to action.
It reminds us that even small steps can make a big difference.
As long as we keep taking them.
You could download that MyPF app we talked about.
Or maybe schedule a call with a financial advisor.
Or even just take a few minutes to write down your financial goals.
And think about how much risk you're comfortable with.
The important thing is to just get started.
It's all about building momentum,
And feeling good about managing your money.
so you can invest in your future.
We want to hear from you.
What are your thoughts?
What questions do you have?
What aha moments did you have during this deep dive?
Share them in the comments below.
Or connect with us on social media
Let's keep this conversation going.
and learn and grow together.
That brings us to the end of another deep dive.
Mabuhay
And Salmat Po.
for joining us on Financially Smart Pinoy.
Don't forget to hit that follow button.
And share this episode with your friends and family
We'll be back soon
with more deep dives
to help you on your journey
to financial freedom.